All right, let's get right into it. If you think you know crypto, I want you to just wipe the slate clean for a second. The game has totally changed, and the old playbook, it's not just outdated, it's obsolete. We're going to walk through the new rules for navigating the crypto market of 2026.
And really, this right here, this tells the whole story. On the left, you've got the crypto of the past. All hype, FOMO, and promises to go to the moon. It was almost entirely driven by retail investors. But now, look at the right side. We're talking utility, compliance, and fundamental value. The big institutions are here, and they are playing a completely different ballgame.
So, what does this actually mean for you? It means the old crypto is dead. Seriously, the strategies that might have worked before, they're not just going to fail you today, they're practically a recipe for disaster. It's time to adapt, or you're going to get left behind.
And that's really the heart of it. We've moved from this wild, speculative free-for-all into what we're calling the institutional era. It is just way more sophisticated. The things that drive value now aren't just hype cycles. It's real institutional capital, clear regulations, and projects that actually do something.
Okay, so how do you navigate this new world? How do you win? It's actually pretty simple. You have to start thinking like the institutions, and we're about to break down their exact playbook, pillar by pillar.
And here they are, the 4 pillars of analysis that the pros use. We've got number 1, the team and governance behind a project. 2, its technology and actual use case. 3, the big one, tokenomics. And 4, its utility and the incentives that drive it. If you can nail these 4 areas, you're already way ahead of the curve.
Let's kick things off with Pillar 1, the team. Look, institutions are investing millions, sometimes billions. They need to know who's steering the ship. They're looking for founders with serious experience, whether that's from traditional finance, you'll hear that called TradFi, or seasoned crypto veterans. And they want to see transparent, decentralized governance, like a DAO, a decentralized autonomous organization, where the community actually gets a say. That's a huge green flag.
All right, pillar number 2 is all about the tech, and maybe more importantly, what it's used for. A project has to solve a real problem. We're seeing real traction with things like tokenizing real-world assets, or RWAs, and with Layer 2s, which are basically upgrades that make blockchains way faster and cheaper. And you better believe the pros are digging into that white paper and checking if the roadmap is actually realistic. Okay, you have to pay attention to this next one. Pillar 3, tokenomics. This can make or break an investment. And we need to talk about a key concept, FDV versus circulating supply. FDV stands for fully diluted valuation. Now here's the trap. If you see a project with a massive FDV, but only a tiny percentage of tokens are actually circulating, that is a giant flashing red light. Why? Because it means there's a huge wave of tokens that will be unlocked later, creating massive potential sell pressure down the line.
So how do you spot good tokenomics from bad? Here's a quick cheat sheet. A green flag, long vesting periods for the team and investors. We're talking 3 to 5 years. The red flag, a low float, that low circulating supply we just talked about, and a huge chunk of tokens given to insiders and venture capitalists. Because that means you, the retail buyer, could just be their exit liquidity, and we do not want that.
Okay, so how do we actually see what's happening under the hood? How do we avoid these traps? You've got to look beyond the simple price chart. The pros, the institutions, they're digging into on-chain data. That's where the real story is.
Right. So the question is, how do the pros measure the health of a crypto ecosystem? What metrics are they actually looking at? Let's dive in.
This table lays out some of the big ones. First, you have ETP net flows. That's basically tracking how much institutional money is coming in. Then, active addresses, super important. It shows if people are actually using the network. Total value locked, or TVL, tells you how much capital is committed to a project. It's a measure of trust. And finally, the DEX to CX ratio, which shows if people are embracing decentralization. These are the vital signs of a healthy project.
And speaking of that ratio, this chart gives you a great visual. We're seeing this steady trend where more and more trading is happening on decentralized exchanges, or DEXs. What does that tell us? It tells us people want more control, they want more transparency. It's a really powerful shift in the market.
All right, so we've looked at the project level. Now let's zoom out. Because there are these huge macro forces at play that are shaping this entire industry for the next cycle.
And really, it boils down to 3 main pillars for this new era. You've got regulatory compliance. Yep, regulation is a pillar now. You've got institutional integration. And finally, these amazing technological synergies. These are the major currents you have to be aware of. You know, for years, regulation was a scary word in crypto.
Not anymore. Now it's actually the key to unlocking the next level of adoption. Clear rules, like the proposed Genius Act, are basically giving big institutions the green light they've been waiting for. Compliance is no longer optional, it's the price of admission.
And on the tech side, things are getting really exciting. We're talking about incredible synergies. You have AI and crypto coming together for things like decentralized computing. The tokenization of real-world assets is bridging the gap between traditional finance and DeFi. And interoperability is finally starting to work, letting all these different blockchains talk to each other seamlessly. This is where the mind-blowing innovation is happening.
Okay, but let's be real. With all this opportunity, there's also a ton of risk. So how do you play in this new arena without getting burned? Let's talk about a solid risk management framework for today's investor. Here's a quick mental checklist of red flags you absolutely need to watch out for. 1. Aggressive, flashy marketing, especially when the tokenomics are garbage. 2. A project that hasn't been audited by multiple reputable security firms. And 3. Completely ignoring the bigger picture, like what the Federal Reserve is doing. These are the classic traps. And this is maybe the most important piece of advice. Let's talk about how much you should actually invest. Look, for most people, a smart, responsible approach is a small allocation. Think somewhere in the 1 to 5% range, as just one part of a well-diversified portfolio. This gives you upside exposure without risking your entire financial future. And don't just take my word for it. This quote from Grayscale, a massive institutional player, really hits the nail on the head. They say the new era is defined by transparency and programmatic scarcity. It's not about hype. It's about verifiable truth and sound economics.
So if you take only one thing away from all this, let it be this. The entire mindset has to change. We have to move from short-term speculative trading to long-term fundamental investing. The future of crypto belongs to the patient, informed investor.
So, I'll just leave you with this one final question to ask yourself. The crypto market has definitely grown up. The question is, have you? It's time to level up our thinking and embrace this new, more mature era of crypto.